C Group, the company behind Shopee and Garena, has seen its market capitalization shot up 315% this year to $79 billion US. That makes it the most valuable company in Singapore. So what happened to C Group that makes it more valuable than DBS Group and Singtel combined? And the most important question is, can we still invest in this company now? Let us dive deeper into C today. Hi guys, Stanley here. We have so much to talk about today. C Group, currently the largest company in Singapore, has a fascinating history. The company started as a gaming company, Garena, back in 2009. It was founded by Forrest Lee, Gang Ye, and David Chen. Although all three founders were born in China, they have been in Singapore for many years. Co-founder Gang Ye and David were even educated in Singapore. But the story of C Group started with Forrest Lee, the current chairman and group CEO. Forrest came to Singapore first when his wife got a job here. Within a year, he decided to start his first business called GG Games. Although he got angel funding from many high-profile investors like Kok Poon Hong, chairman of Wilmar International, GG Games were not able to take off. However, the experience was valuable to Lee, and he soon got over the failure and decided to try again. This time though, he called upon Gang Ye and David to join him, and they launched Garena. During that period in 2009 when they launched, social gaming was just taking off, and Garena was able to catch that trend and design a platform for gamers to easily communicate and form clans among themselves. And also by winning the exclusive license to League of Legends, the hottest game during that time for the Southeast Asia region, Garena was able to grow into a regional gaming powerhouse. From that success, Garena pushed forward into more markets and started developing their own games as well. And with the profit from its gaming business, Garena moved into digital payment space with C-Money, and most recently in the e-commerce platform as well with Shopee. That is when Garena transformed into the current C Limited. With all these three segments growing very strongly during this pandemic, C Group's share price also rallied more than 300% with rising expectation. But going forward, is C Group still a great stock to own? To answer that question in detail, we bring in two sides of me to analyze that. Joining me today is Optimistic Stan, hello, and Pessimistic Stan. Hey man. Let us start with Optimistic Stan. So why is C Group such a great stock to own? Thank you, moderator Stan. Personally, C Group has one of the most impressive growth records I have ever seen before. Its revenue more than doubled in 2019, and it looks set to double again this year. Its gaming business still has a long growth prospect, as the company has inked a long-term distribution partnership with TENCENT Holding, allowing the company access to a huge library of games from the world's largest gaming company. On top of that, C has also proven that they can develop their own successful games like Free Fire, which has reached more than 100 million active gamers now. And across all its games, it has recorded close to 500 million active gamers across 130 markets. Gaming is also its most profitable business, with a gross margin of 60%. This is a segment which grew 87% for the first half of this year alone. So with its gaming business alone, C Group will be a very profitable business. However, what is more impressive to me is that the company is not sitting still with just this achievement. It has reinvested its profit from the gaming into two of the fastest growing sectors in the region, digital payment and e-commerce. The company has huge ambition, and that is what we should be looking for if we are looking for a growth company. In an interview with CNBC, management has stated that they are not just looking to be the Tencent of Southeast Asia, but rather it is going after the business model of Tencent, Alibaba, and Ant Group, and be the definitive app in gaming, e-commerce, and digital payment in the region. And they have not been just talking about it, but rather their results are showing that C Group is succeeding in this ambition. So much so that they have attracted the investment of TENCENT Holding, which instead of trying to compete with them in Southeast Asia, has decided to just invest and partner with them in this region. TENCENT Holding is now one of C's largest shareholder and has board representative in C as well. This means that C Group not only has the ambition, but now also has the guidance of Tencent to become a key tech business here in Southeast Asia. Its e-commerce effort is also showing results. Started only in 2015, Shopee is now the largest e-commerce platform in Southeast Asia and number 1 in key markets like Indonesia. Shopee has been winning market share away from competitors over the past few years. Its gross merchandise value has grown close to 110% in the second quarter this year to $8 billion. And with the success of Shopee and Garena, Sea can easily scale its digital payment solution as well. Today in Indonesia, about 45% of all orders on Shopee already go through its digital payment platform. And with so much of the population in Southeast Asia still do not have access to basic financial services, Sea Money has a big blue ocean for it to grow into. Just think about it, if we look at Tencent, Alibaba and Ant Group, they now have a market capitalization of about $1.7 trillion combined. And that value is generated from a market with a population of 1.4 billion. And the whole of Southeast Asia has a population close to 670 million people. And the population growth is actually much faster than in China. Although this is a market about half the size of China, even if we assume that the spending power of an average Southeast Asian can only reach about half of the level of an average Chinese consumer, we're still talking about a potential market capitalization for Sea Group of about 350 billion over the next decade. That is close to 3.5 times its current market capitalization of just $80 billion. More importantly, we are just talking about the Southeast Asia market. Currently, Sea Group has also entered and has presence in other large markets like India and Brazil. So our expectation is not even taking account into this huge market. My thinking in Sea is quite simple. Here we have a company that is being guided by Tencent Holding, one of the most successful technology company in Asia, and has the potential to grow at least 3.5 times from its current market capitalization, or even more. And it can achieve that simply by following the playbook that has already been proven by Tencent and Alibaba. All it needs to do is to implement the playbook again in this fast-growing market, Southeast Asia. So should we as investors really pass on such a once-in-a-lifetime opportunity? Just think about it. Hey, help me buy some Sea Group now. Oh hi, welcome back. Thank you Optimistic Stan for the impressive thesis. Now, it is important for us to hear both sides of the story in any good analysis. So let us go over to Pessimistic Stan on why we should not be investing in Sea Group at all. Alright, thank you, Moderator Stan. You might want to cancel that order for now. Let me break down his argument one by one. For starter, his assumption that Sea Group could be the champion in Southeast Asia is flawed. Very flawed. Unlike China or even the EU, Southeast Asia is an extremely fragmented market. Each Southeast Asian market has its own currency, culture, and not to mention government bureaucracy. So being successful in Singapore does not mean anything in the Indonesian market and vice versa. The market is extremely competitive and need huge localization for each market. This makes its cost of operation extremely high. And unlike China where you can streamline some operation to save some costs as you scale, in Southeast Asia your operating costs might need to increase even as your scale increases. So far, there is not one e-commerce company in Southeast Asia that has proven to make their business model profitable. So, even though it has gained market share in the e-commerce business, you can see that its gross margin in the e-commerce business is still negative. This means that Shopee is paying more money to its customer than it is earning from them. If I buy something for $100 and sell it for $90, that's not a business, that's a charity. As for its digital financial services, we are talking about operating a digital payment service in Southeast Asia. There are tons of financial frauds, scam, and money laundering activity across the region. And a new and less regulated payment service like Sea Money can easily be misused and abused by criminal organizations. So the risk of operating Sea Money in this region is extremely high. Not to mention the amount of regulation or bureaucracy they have to work through in every single market will be huge. Even after all that, they still have the problem of cross-border transaction in the future. As for its gaming business, although it's the profitable part of Sea, most of its successful games are still licensed games from other companies. It only has one popular game on its own, Free Fire. So the success of its gaming business is still very dependent on its partners, like Tencent. It does not have a clear moat in its own gaming business. Moreover, the company is hugely unprofitable. Its net loss is more than its revenue in 2018. And in 2019, its net margin is actually negative 42%. This means that for every dollar it is earning, it is losing 42 cents. And the only way the company can continue to fund the business is from the debt market or the equity market. And to do that, it needs a stock valuation that continues to be high. If its stock price falls, it will lose the ability to raise more money as well. And tying the success of the business to how high your stock price is extremely risky because the stock price is out of control of the management. Not to mention the current high valuation. C has a market capitalization of 80 billion US dollars. Yes, but that is a company that only generated a revenue of 2.2 billion US dollars in 2019. That is a price to sales ratio of 36 times. In comparison, DBS Group, which has a market cap of 54 billion Sing dollar, but it is backed by a revenue of 14.5 billion Sing dollar last year. And that's a price to sales of just 3.7 times. So C has a market size of twice of DBS, but only a revenue that is 20% of DBS Group. Does that make any sense to you? If that's not enough to make you doubt this stock, look at its organization structure. Its organization structure is very complex. Even though the VIE structures are made famous by many Chinese tech stocks, C, a Singapore-based company, also has many VIE structure in its operation as well. VIEs are just legal agreements that allow non-related companies to flow its profit to another party. And this means that legally, C might not even own the operation of some of its business. In their 2019 annual report, about 20.4% of all revenue is actually coming from these VIEs instead of their own subsidiary. So if the structure are challenged in the future, its revenue might be in jeopardy as well. On top of that, it says that it wants to be the Tencent, Alibaba and Ant Group of Southeast Asia. But when we look at the history of Tencent and Alibaba, they have been profitable very early on in their business and have stayed profitable throughout their growth era. But here we have C, which has been growing for more than a decade and still generating huge losses year after year. Why is that the case if it is merely just copying the business model of Tencent and Alibaba? So just think for yourself, will you pay a 36 times premium over its revenue for a company that is generating most of its revenue from games developed by other companies, an e-commerce business that is gaining market share by subsidizing its customers, a company that is operating in a highly fragmented market with no real profitability in sight, and a business model based on a questionable corporate structure? Is this growth that is completely without profit worth the risk? Alright, thank you Pessimistic Stan. There you have it guys, you heard it from both Optimistic Stan and Pessimistic Stan. Who do you agree more with? Comment down below if you will invest in C Group or stay far away from it. As always, till we meet again, invest safely.